In this video, we will talk some more about risk, in this case, credit risk, and we're going to focus more on individual loan risk from the perspective of a financial institution, not the borrower necessarily. There are all kinds of loans out there, secured, unsecured, syndicated, spot loans, fixed rate, adjustable rate, mortgages, et cetera, et cetera, et cetera. There's other forms of debt, like bonds, for example, which are type of loans in a way, but there's a security. The point is that the different names have to do with how the loan was structured and how it's built and for what purpose. Who's the borrower? Who's the lender or lenders? Like the syndicated loans could have more than one lender coming together. Or if it's just one bank lending to a syndicate, there's plenty of them. However, the one thing they have in common is you lend money and you charge an interest. And what interest you charge will depend on a lot of different circumstances of the market, the borrower herself, and potential changes in the future, and so on and so forth. So let's take a look at some of these things that impact and influence credit risk. And of course, the chapter is about credit risk. So the higher the risk of issuing this credit to somebody, then the higher the interest rate they should claim. Or if the risk is too high and the interest rate exceeds a certain amount, it's probably not worth issuing that loan or approving that loan. So let's talk about individual loans, also known within this context, consumer loans. So consumer loans are what most people will deal with in their lifetime, unless you work in banking or in a financial institution that lends out money. Personal loans, as signature loans, no collateral. You're just saying, hey, I will pay you back, but if I don't, I'm not going to give you anything in exchange. Auto, on the other hand, if you don't pay, they take the car back. So the car is somewhat of a collateral, similar to a mortgage. The house is collateral for the loan, so they represent lower risk. Credit cards, similar to personal loans. The difference between a personal loan and a credit card is a personal loan it's called non-revolving. So it has a time limit. It more than likely will be a fixed rate, but it doesn't have to be. But the point is that you make payments and it starts bringing down the loan to an end. Revolving loans, like a credit card, you use it, make payments, the credit becomes available again. So it revolves, the credit keeps on becoming available. And lines of credit are similar that way as well. Now, risks associated to these type of loans and credit is not just the borrower it's not just the person borrowing the money, but there are competitive conditions. There are other companies competing against those customers. And there's also usury sellings, meaning usury laws are laws that only allow a maximum amount of interest rate to be charged depending on the type of loan. There are different ones. Some of them are very high, like a pawn shop can get away with a very high, typically a pawn shop gets away with a really high interest rate, while things like credit cards and other consumer loans may not. And that's what usury ceilings are. So if interest rates start going up, there's only so much you can charge. There's a cap. High default rates during financial crisis highlight the importance of risk evaluation prior to making a credit decision. The 2008 being the most recent big financial crisis we had that had to do with credit. There was how can I say this? I don't know if it was, I can say it's a poor approach to evaluating risk, or a less comprehensive. It wasn't painting a good picture, and then all of a sudden it caught up with everybody. There are other types of loans, like I said, and these are just examples. There's even more out there. Farm loans. Well, these loans may have special conditions to favor farmers in order to keep them in business. Loans between banks, definitely a different set of conditions and interest rates. Non-bank financial institutions, like brokerage companies, but they're still financial institutions. They're just not a bank in the sense of the definition of a bank, like a depository bank, checking, savings, etc. Foreign banks and sovereign governments, so same thing, but abroad, outside the country. And state and local governments. Yes, if you buy a state bond and a municipal bond, you are lending to the government, but the government may also engage in just borrowing straight up loans from financial institutions. Now, calculating the return on a loan. Before we continue, while we'll go over what this does and what it means, to actual examples of this formula and how to calculate will come from the textbook. So factors: prime lending rate, fees, credit risk premium. Now they're bunching up a lot of stuff here because you got the real interest rate, the risk-free rate, then there's inflation premiums, maturity premiums, default risk premium, etc. So they're just kind of bunching them up here and say credit risk premium. The fees that come with it, is there collateral or not? That, as we mentioned earlier, if there's collateral, the risk is lower, so the premium can go down, the interest rate charge, and other non-price terms, such as compensating balances and reserve requirements. These are things that will affect a financial institution, and depending on their position in the balance sheet, for example, they may or may not have to start increasing interest rates. And it's kind of in a way, supply and demand situation. Return, this is how you calculate it. It's pretty much at the end of the day, inflow divided by outflow, right? So this is the formula in essence. Now the expected return can be broken down to saying, well, 1 plus the expected return equals a probability of a complete repayment. And then you can go ahead and do your algebra and calculate that. So actual return and expected return. And those differences will tell you pricing strategies, etc. Now consider default risk. It considers default risk, which is not as easy as it sounds to calculate, or if there is no real straightforward. We have some methods that are better than others. Some are simpler. But the point is that default risk is a big one. How can you guess if somebody is going to default and not pay? Because there's so many reasons for somebody to default. But to calculate that risk is difficult and can make or break a financial institution on their lending side of the business. Know that realized and expected return may not be equal. This is realized, that's the actual, this are expected. And to be honest, most of the time, they will not be equal. Sometimes the difference is large, sometimes it's not. Retail versus wholesale credit decisions. Retail as in one-by-one type of selling versus somebody may act as an agent and issue or originate a bunch of loans and then just sell it as a packet to a bigger bank, for example, or something like that. So a retail, usually a simple accept reject decision rather than adjustments to the rate. So either you qualify or you don't. Credit rationing. Rationing, just what it sounds like. You only have so much capital to go around. You have to pick and choose who you lend to. Of course, you want to play the game of the highest rate of return you can get while minimizing default risk. Just like you would with a stock, a risk return situation. If accepted, customers sorted by loan quantity, as in the amount they're borrowing. For mortgages, discrimination occurs via loan to value rather than adjusting rates. Discrimination, I know sounds like a bad word, but they're not saying that in that way. What I'm saying is that it's not the same if you're lending money out to somebody with no collateral versus somebody with collateral. Now, because let's say you do a loan to value of 80%, the house, for example, if it's worth $100,000 and you're only lending $80,000, your risk is very low because you should be able, in theory, to liquidate that property and recover your money, and with very little risk. Of course, Each situation is unique, but that's what they're talking about. The discrimination occurs via loan to value rather than adjusting rates. At wholesale, I guess one way to say too is like if instead of giving you a higher rate, they can say, well, put in a larger down payment. That'll be one example of one of the many ways they can deal with this. At wholesale, use both quantity and pricing adjustments, as in amounts of the loan, and then what kind of rate they should like, because they look at it as a whole, as a package. And of course, being wholesale, you would expect some discounting. Default risk models. Okay, so default risk being the one they're interested in the most, because that's pretty much the one that decides, or pretty much the one that tells you the money's going to come back or not. The other risks may affect your profitability, your expected returns, or your actual returns, but you're still getting your money back, just not as, you're not making as much as you expected, which could be a problem. Don't take me wrong, but default risk is the big one, because that one says you're getting zero back, or all of a sudden it stops and you lost all that difference. So this is a highlight within the risks. Availability, quality, and cost information are critical factors in credit risk assessment. So yes, we do have credit scores in the United States and all that, but even then, information is key. And this is using like a technical approach, meaning your history, but it's not looking at your future. Facilitated by technology and information. So when I say future, then the lender has to make an estimation of what the future looks like. Would it continue to be as the past, better or worse? Qualitative models consider borrower-specific factors as well as market or systematic factors. So a combination. The economy is going down. There's going to be a recession. There's going to be a lot of job loss. So that's a risk that is not borrower specific, but it could increase your default risk because that person may lose their job. Also, even if a similar situation about job loss that is now borrower specific instead of systematic is what kind of job does that person work in? So the loss of income in the future could be because the type of job that person has. Is it seasonal? Is it one of those jobs that are high risk of high turnover? Or is it because the economy is looking bad and there might be a lot of layoffs coming up in the future in all jobs? Or it could be a combination of both. So that's ways to look at factors that could be from the person borrowing the money or from the market itself, the system. So borrower-specific factors include reputation, leverage, volatility of earnings. Volatility of earnings is similar to what I was talking about, that their job could be not as steady as other jobs, and collateral, whether it's a home or not. Things like reputation and leverage. If you want more information, you want to look for the 5 C's that are the basic items used for the credit score and to evaluate somebody's credit worthiness. Market specific factors include business cycle, like I mentioned, recession, and interest rate levels. If the interest rates are expected to go up in the future, you're going to have to charge a higher interest rate now. And that's not because of the person borrowing the money. That has to do because the economy will be moving in that direction in the future. So ways that we try to do this credit scoring so we can then apply the proper interest rate we should be charging on a loan. So credit scoring models are quantitative models that use borrower characteristics to gauge an applicant's probability of default. You heard it all the time, your credit score. Now, using a linear probability model like the one you see on the screen, it has some weaknesses. And the reason is the math may allow for something below 0 or above 1, and probability is supposed to be between 0 and 1, 0% and 100%. So there's it may step out of bounds and not give you a useful number sometimes. Since superior statistical techniques are already available, there's rarely justification for employing linear probability models. In other words, this exists, people don't use it, or they shouldn't. Now, you still can use it as a supplement. it's not abnormal to have multiple approaches to it. And according to the scenario, they may say like, well, let's make an adjustment because of XYZ reasons. But it should not be the one that drives your decision. So logic model is very, very similar to what we just discussed, except that puts a boundary between 0 and 1. So quality of credit scoring models have improved, providing positive impact and controlling write-offs and default. So this is an improvement to the probability model. And a logic model is another form of regression, to be honest, just with it applies a little different methodology on the statistics, and it bounces between 0 and 1. We have a discriminant approach. There's this thing called the Altman's Z-score. Here, the percentage is Altman's discriminant function. It is also a linear model like this. Now, this is a little different. What it's doing is, once you punch in the values here, these are constants. This 1.0, 0.6, 3.3, 1.4, 1.2. And then you take these ratios from the person borrowing, let's say whether it's a company or an individual. Sales to total asset ratio, one way to modify that, if it's an individual, not a company, will be their income. How much money do they bring in versus their assets on their net worth, liabilities, and assets. You can do that. So you can modify these terms for an individual. Now, the thing is, it says critical value. So when you punch in these values in here and you add them together, if it's below 1.81, it's almost certain that they will default, and not too far in the future. It will be like a near future default. And this model actually is pretty good at predicting bankruptcy, defaults, and things like that. Anything above 181, you start getting into the safe zone. Actually, the higher the number, the less the default risk. But like everything, there's not a perfect, because it only really considers two extreme cases. It doesn't really give you a probability. It just says below this number, default, but above that number, no default. Well, obviously, the lower the number, the higher the chances of default. And you have to adjust your interest rate that way. And if it's somebody with a 1.82, which is barely above the number, versus somebody with a 2.5, maybe the person with a 2.5 should get a better rate. But this model says, nope, they're both well on the non-default situation. And that's what we're talking about, the weights on credit scoring, etc. But the point is, default, no default is the main thing that causes these other problems you see on the screen. Okay. So we have the term structure derivation of credit risk. If the risk premium is known, now that's the big if first, we can infer the probability of default. Now in the United States, because we have the treasury bills and the federal bonds, the risk premium, it can be extrapolated. It's kind of a little easier to get to because we have information. Now, but you still have to compute it. We're not saying that the treasury bonds or the zero coupon corporate bonds are the risk premium. Is they can use that to calculate risk premium, because what you're doing is you're looking at similar securities that have the similar level of risk, and whatever interest rate those are, whatever risk premium is associated with those, then that will be similar to the premium you should be charging. So risk premium can be computed using treasury strips and zero coupon corporate bonds. Those two type of bonds, they do the same. It's just that when they're private, corporate, we call them zero coupon bonds. In a treasury strip, the strips do the same thing. Both of these bonds do not pay coupons, do not pay coupon payments, do not make coupon payments. So it's just always purchased at a discount, and then it just goes up in price. The reason why we use them to calculate the risk premium, because then we don't have that noise of what a payment is made, so the risk changes, etc., so on and so forth. It's a cleaner way to see the risk premium with associated risk. Now, technically speaking, you could do the math with one that pays coupons, but to be honest, why bother? You typically can find something with a similar risk level that is zero coupon or a strip. Now, mortality rate models. Okay, so let's talk about insurance companies for a moment. An insurance company will measure the risk of a life insurance policy based on the mortality rates. So they have a lot of data. They look at the history and the probability of somebody dying within so many years according to their age, gender, et cetera, medical history, so on and so forth. And that's how they decide how much they're going to charge the person for life insurance. So you can kind of look at it the same way, but instead of the person passing away, dying, it is the default risk. I guess you can say the risk of the loan dying itself. And you can do it year by year. So you take the default in year one divided by the outstanding amount in year one, and that will give you that rate of year one. And you keep on going year two, year three. Of course, as the loan is being paid back, the risk of default is going down, or at least the risk of loss is going down because you already recovered some of that money. Now, it has problems associated with credit scoring models, such as sensitivity to the period chosen to calculate the MMR, sample bias, because you're using like a mortality table. You see past that on defaults. It's not the same to give an extreme example. It's not the same to use the mortality rates of 1920s or the 1800s for that matter, if you want to go very extreme, to today's mortality rates. So the point is that if you go back 10 years, 20 years, 30 years, how far back do you go to get those averages? The more data you get, it should become a better prediction, but then you need adjustments for changes in technology and medicine, et cetera. It's sensitive to that. What period should you choose? What's sensible? Now, let's talk about calculating the risk-adjusted return on capital. This is about efficiency. We were talking so far about, okay, what do I get? What's the return? What's expected return? Now, what return am I getting according to the risk I'm taking? And that's risk-adjusted return. So one of the most widely used models is what you're seeing on the screen. That's just the acronym for risk-adjusted return on capital. And what you do is you take the 1 year out risk divided by the loan risk as a whole. And that gives you your risk-adjusted return on capital. Well, your 1 year, let me rephrase that. Your 1 year return, year out, minus any risk-free premiums or anything that you have to take out, and we'll talk about that in a moment, divided by the entire loan risk. Now, how do you get the loan risk? This one, it's easier to deal with, but this is the one we're talking about this chapter so far that, well, this loan risk calculations, they all have flaws. It's not perfect, and all that. Well, one acceptable method to get the loan risk for that 1 year, because notice 1 year out, right? So about a year by year. The loan risk estimated from loan default rates or using duration. So you can do the default rates, kind of like some of the ones we discussed before, using historical data on default rates, or you can use duration, which we discussed in a previous chapter. Duration can also be used here because it gives you how something changes over time according to the interest rates. And these are sensitive to interest rates. So now, this here we're talking on this slide, we'll talk about it in a moment. Just understand, please, that it is not substituting this formula. That is just showing you how to get the denominator, the loan risk, this number that goes down here. You can calculate it here, and that's the number that will go at the bottom here, and then you calculate the risk-adjusted return on capital. So for denominator, it says right there, the risk-adjusted return on capital, the duration approach, which is not too bad to calculate, used to estimate loss and value of the loan. So The same way you learn how to calculate duration in the previous chapter, you would do a calculation of duration for the loan. You put the negative in front of it to that factor, and then you multiply by the change in rate. I will expect the change in rate divided by 1 plus the current rate. And that will give you the change in loan risk, or what you can eventually then calculate the expected change in loan risk, which you can also move these around to get the loan risk that you're looking for specifically. So it depends what data you have. Option models. This is left towards the end of this lecture, and is because this seems to be the way of the future, to put it that way. Just like it sounds, options. Option pricing models have evolved to a very high degree of accuracy, and taking into account market sentiment and other implied values out there that are not necessarily part of the technical data available. So what they do is they modify and derive formulas from the option pricing model to then price these loan risks and premiums, etc. So in this slide, this is what you're looking at, this one here. They're just showing you the history behind it. So then you can modify, that formula gets modified with these values, because what you have here on the left is what you want: the required yield on the risky debt. For example, let's talk about CAPM for a moment. CAPM, when you calculate CAPM, you're using beta as the risk factor, and there's a risk-free rate and the market premium, etc. But the point is that CAPM tells you what's my required return based on the risk that I'm taking, the market conditions, and what the risk-free rate is out there. So you got to take out the risk-free rate, because you shouldn't get paid for that part. So that's what you're seeing here on the left, is the required yield on risky debt. So what's the interest rate you should be charging? But then you got to do minus the risk-free rate on debt of equivalent maturity. And is because, well, that's risk-free. That percentage, you cannot count it as part of your return, because you could have just then invested there. So it's that premium, that difference between the required yield and the risk-free rate. That's what you know. That's the premium you're getting. All right. Again, examples on how to apply these formulas come from the textbook. Now, Moody's. Now, let me go back. So this is the basic example. However, things can be modified and tweaked and adjusted. Moody's has what they call their option pricing model approach. And what they do is they use this option pricing model to then take or extract what we call implied market value of assets and implied volatility of those assets for given firms. Now, without getting too deep on what the word implied here is a very specific thing. If you go back and review option pricing models, especially the Black-Scholes and some other ones in that line, implied volatility is a very important factor, because there's, let's say, actual and real volatility versus implied volatility, meaning that, let's say you do a calculation and use actual volatility, and your number, your price is not the same as the one you've seen in the market. That means the market is taking consideration some other items, and it's the implied volatility is one of them, saying like, well, yeah, that's the volatility, but we're pricing it as if the volatility was this. It could be anything. It's just a market sentiment. It could be any given reason. It could be a supply and demand situation that is changing volatility, changes in stock prices, so many things, but it's an implied volatility, meaning that it may not be the actual volatility observed, but the way it's being priced, you can then reverse engineer it, if you want to say it that way, to then extrapolate what the market thinks the volatility is actually there. and it allows you. So that's one way to look at it. It's a little more complex than that, but the point is that if you can take out the implied volatility, it tells you more about what's really going on in the market. And it doesn't mean it's right or wrong. They could be right, they could be wrong. What it is that's what's happening. That's important. You have to price according to what's happening. Now that bullet there is letting us know that this approach is newish, considering you still got to wait many years to see if a model really works when it comes to economics and finance, but it's showing good results. It seems to be one of the more accurate models out there. And even if it's not the more accurate one, is heading in the right direction. So maybe tweaks and improvements as we learn more about it. And this seems to be the way of the future, unless somebody comes up with a different model that even proves to be even better. That's it for this video. See you on the next one.